In the everyday lives of people across ASEAN countries, interest calculations are involved in almost every financial scenario. Residents in Thailand deposit their spare money in banks and receive additional interest when the deposit matures. Small and medium-sized enterprises in Vietnam apply for bank loans to expand their businesses, and when repaying the loan, they must pay not only the principal but also the corresponding interest. In Malaysia, when households apply for home mortgages, each monthly payment includes both a portion of the principal and a portion of interest. So how exactly is interest calculated? What differences arise from different calculation methods? Today, we will take a closer look at the two main methods of interest calculation, clarifying their formulas and typical applications. In this lesson, we will cover three main topics. 1. The method of calculating simple interest. 2. The method of calculating compound interest. 3. The differences between the two methods and their applications. Simple interest is the most basic method of interest calculation. Its defining feature is that interest is calculated only on the principal. Any interest earned previously does not generate additional interest. In other words, interest does not earn interest. The formula for simple interest is simple interest equals principal times interest rate times time. Accordingly, the total amount due at maturity, that is, principal plus interest, can be expressed as total amount equals principal plus simple interest equals principal times 1 plus interest rate times time. It is important to note that the units of the interest rate and time must be consistent. If the interest rate is an annual rate, time should be measured in years. If the interest rate is a monthly rate, time should be measured in months. Only then will the calculation yield correct results. Example 1. A resident of Singapore deposits 10,000 Singapore dollars in a bank at an annual interest rate of 3% for 2 years. Simple interest equals 10,000 times 3% times 2 is equal to 600 Singapore dollars. Total amount after 2 years equals 10,000 plus 600 is equal to 10,600 Singapore dollars. This method is commonly used by banks in ASEAN countries for demand deposits and short-term loans. Example 2. A farmer in the Philippines takes out a loan of 50,000 Philippine pesos from a rural bank at a monthly interest rate of 1% for 6 months to purchase seeds. Simple interest equals 50,000 times 1% times 6 is equal to 3,000 Philippine pesos. Total amount to be repaid at maturity equals 50,000 plus 3,000 is equal to 53,000 Philippine pesos. Compound interest refers to a method in which the interest generated by the principal is added to the principal at the end of each interest period, and interest in the next period is calculated on this new total. In other words, it is interest on interest. The formulas are as follows. Total amount under compound interest equals principal times 1 plus the interest rate to the power of time. Compound interest equals total amount minus principal. Example 1. A Malaysian investor deposits 20,000 Malaysian ringgit in a time deposit at an annual interest rate of 4% for 3 years, with interest compounded annually. Total amount after 3 years equals 20,000 times 1 plus 4% to the power of 3 equals 20,000 times 1.124864 is equal to 22,497.28 Malaysian ringgit. Compound interest earned equals 22,497.28 minus 20,000 is equal to 2,497.28 Malaysian ringgit. Note, 1 plus 4% to the power of 3 is equal to 1.04 times 1.04 times 1.04 equals 1.124864. Example 2. A student in Thailand applies for a study abroad loan of 100,000 Thai bahts at an annual interest rate of 5% for a loan term of 2 years, with interest compounded annually. Total amount after 2 years equals 100,000 times 1 plus 5% to the power of 2 equals 100,000 times 1.1025 is equal to 110,250 Thai bahts. Compound interest earned equals 110,250 minus 100,000 is equal to 10,250 Thai bahts. There are clear differences between simple interest and compound interest. Simple interest is relatively easy to calculate, as it involves only 3 factors: the principal, the interest rate, and time. It does not take into account the reinvestment of interest, so it is commonly used for short-term loans or savings products. In ASEAN countries, commercial loans with maturities of less than 1 year and demand deposits are mostly calculated using simple interest. For example, a small vendor in Indonesia may apply for a 3-month microloan from a community bank to purchase inventory. The bank usually calculates interest using the simple interest method, which is both convenient and easy for both parties to understand and apply. Compound interest, by contrast, better reflects the time value of money, because it allows interest to participate in the growth process. The longer the time period, the more pronounced the cumulative effect of interest becomes. Therefore, compound interest is commonly used for long-term investments or long-term loans, such as time deposits in Singapore, especially those with longer maturities, and home mortgages in Malaysia, which are typically calculated on an annual compound basis and then allocated into monthly repayments. According to statistics, 80% of long-term loans in ASEAN countries in 2023 adopted compound interest calculations, which highlights the importance of compound interest in long-term financial activities. In this lesson, we systematically studied 2 methods of interest calculation: simple interest and compound interest. The formula for simple interest is principal times interest rate times time, while compound interest can be expressed as principal times 1 plus interest rate to the power of time minus principal. We also learned that simple interest is easy to calculate and is suitable for short-term savings or borrowing, whereas compound interest better reflects the time value of money and is therefore more appropriate for long-term investments or loans. In financial activities across ASEAN countries, whether saving money or borrowing funds, accurate interest calculation helps individuals and businesses plan their finances more effectively and avoid unnecessary losses caused by calculation errors. We encourage you to practice more after class so that you can master these 2 calculation methods with confidence.